Most federal employees are investing thousands into their TSP without the slightest clue where that money is actually going. If you've ever logged into your TSP account, looked at the funds, and felt totally lost, you are not alone. These 5 little letters are quietly deciding how fast or how slow your retirement money grows. And the truth is, picking the wrong mix could cost you tens of thousands of dollars over the next few decades. So in this video, I'm going to break it all down for you in plain English. No confusing financial jargon, no charts that make your eyes glaze over, just clear, straight to the point explanations of what each fund does and how to actually use them to grow your money. Here's what you're going to walk away with: what the funds really invest in, how risky each fund is, and which ones are best for your retirement timeline and your risk comfort level. We'll even cover the L funds near the end, and I'll give you some sample allocations based on age and FIRE goals. So let's start with the fund everyone thinks is the safest, the G fund. The G fund is like wrapping your money in bubble wrap, but forgetting it needs to grow. Let's talk about the G fund, the one a lot of people default to because it feels safe, and it is. The G fund is the only TSP fund that guarantees you'll never lose a penny. It invests in special government-issued securities that don't fluctuate with the market. It's backed by the US government, so your money is protected from market crashes, recessions, and volatility. Sounds perfect, right? Well, not quite. Because while the G fund protects your money, it doesn't really grow your money. Over the long term, its returns have hovered just above inflation. That means your money is technically growing, but your purchasing power, not by much. So who is the G fund good for? If you're within a few years of retirement and you need stability, this can be a smart place to reduce your risk. If you're already retired and making withdrawals, the G fund can act as a safe bucket for near-term income. And if you're super risk-averse and you just want a guaranteed return, even if it's small, this gives you peace of mind. But if you're in your 30s, 40s, or even early 50s and parking most of your money in the G fund, you're probably missing out on decades of compounding growth. Remember, playing it safe for too long can be one of the riskiest decisions you make with your retirement. Next up, what about bonds? Let's look at the F fund and why it performs better in some years and worse in others. The F fund is like the middle child of the TSP, quiet, dependable, and often overlooked until the stock market crashes. Let's talk about the F fund. This is the fixed income investment fund, and it invests in a mix of US government, corporate, and mortgage-backed bonds. In simple terms, the F fund is built around debt. It's like you're loaning money to big institutions and getting paid interest in return. Here's where it gets interesting. The F fund is more aggressive than the G fund, but less volatile than the stock funds. It's that middle-of-the-road option, moderate risk, moderate reward. Now, when does the F fund really shine? When interest rates are falling because bond values go up. During market downturns, when people flee stocks and flock to bonds. And when you want to reduce volatility in your portfolio without going full safety mode. But it's not all sunshine. The F fund can lose value, especially when interest rates are rising quickly like we've seen in recent years, because when new bonds offer higher rates, older bonds in the fund become less valuable. So is the F fund bad? Not at all. But it's not a solo performer. It's best when it's paired with growth funds like C or S. It adds balance. It smooths the ride. And in certain years, like when stocks are in free fall, it can actually outperform everything else. You might consider the F fund if you're 5 to 10 years from retirement, you're already retired and want to reduce big swings, or you're building a 60-40 or 70-30 stock-to-bond portfolio bottom line. The F fund isn't flashy, but it knows how to protect you when the market gets wild. Now let's get into the real growth engine of your TSP. The fund that tracks the biggest companies in America, the C fund. The C fund is where your TSP goes to lift weights. It's built for long-term strength, but not without some bruises along the way. The C fund is one of the most popular options in the TSP, and for good reason. It tracks the S&P 500, which means it invests in the 500 largest publicly traded companies in the US. Think Apple, Microsoft, Amazon, Coca-Cola, and hundreds of other corporate giants. When you invest in the C fund, you're not betting on a single company. You're riding the wave of the US economy. Historically, the C fund has delivered solid long-term growth. Over the last several decades, the average annual return has been around 10%. Of course, that comes with ups and downs. Some years, you might see gains of 20% or more. Other years, like 2008 or 2022, you could see double-digit losses. But here's the deal. If you've got time on your side, and you're not pulling money out for 10, 20, or even 30 years, those ups and downs tend to even out. That's why the C fund is considered a core building block of any growth-oriented TSP portfolio. When is the C fund right for you? If you're in your 20s, 30s, or 40s, if you're working toward FIRE and need strong compounding, or if you're willing to ride out market dips in exchange for higher long-term returns. Even in retirement, many people keep a chunk of their portfolio in the C fund because it helps outpace inflation and sustain their income over time. One important note, the C fund only includes large-cap U.S. companies. So while it gives you great exposure to established businesses, it doesn't include smaller companies or international ones. That's where the S and I funds come in. Next up, let's look at the S fund, the small and mid-sized companies that bring more risk and more potential upside. The S fund is the wild child of your TSP, high energy, unpredictable, and capable of serious gains if you know how to handle the ride. If the C fund is your steady, mature performer, the S fund is its fast-moving younger sibling. This fund tracks small and mid-sized US companies, the kind that are still growing, still scrappy, and still trying to become the next big thing. The S fund doesn't track the S&P 500. It tracks the Dow Jones US Completion Total Stock Market Index, basically everything in the US stock market except the S&P 500. So when you invest in the S fund, you're getting exposure to companies that aren't household names yet, but some of them will be. Historically, the S fund has had years where it absolutely crushed the C fund. It's had double-digit returns when the rest of the market was flat, but it also comes with more volatility. These companies tend to be more sensitive to economic changes, inflation, and interest rates. So the S fund might drop harder during recessions, but it also tends to bounce back faster during recoveries. Here's when the S fund might be right for you. You're in your early or mid-career, and you've got time to ride out the swings. You want to boost your overall growth rate beyond just the C fund. You believe in investing broadly across the US market, not just the big dogs. The S fund works really well paired with the C fund. Together, they give you exposure to the full spectrum of American businesses, from massive corporations to up-and-coming innovators. Just remember, more growth potential, more ups and downs. So the S fund isn't ideal for short-time horizons or conservative investors. But for those focused on long-term growth, this fund is one of the most powerful tools in your TSP lineup. Alright, so far we've covered domestic stocks, but what about international companies? That's where the I fund comes in, and it's probably the most misunderstood of the five. The I fund takes your TSP global, offering international flavor, but with a side of currency risk and drama. Let's talk about the most misunderstood fund in the TSP lineup, the I fund. The I stands for international, and it gives you exposure to large companies based outside the US. We're talking about firms in developed markets like Europe, Japan, Australia, and Canada. It tracks the MSCI EAF index, which stands for Europe, Australasia, and Far East. You'll find companies like Nestlé, Toyota, and HSBC in this fund, big players, just not American ones. So what's the point of having international exposure in your TSP? Simple, diversification. US markets don't always outperform. There are years, sometimes entire periods, where international stocks deliver stronger returns. By including the I fund in your mix, you're spreading your bets across more of the global economy. But, and this is important, the I fund also comes with added risks. You're exposed to currency fluctuations. If the dollar gets stronger, your international returns could drop. You're subject to foreign market conditions, which may be more volatile or less transparent than US markets. And the I fund doesn't include emerging markets, only developed ones. So you're still missing fast-growing countries like India or Brazil. Historically, the I fund has had strong years and weak years, just like the others, but it tends to move differently than the CNS funds. That's a good thing when you're trying to reduce your portfolio's overall volatility. So, who should consider the I fund? If you want to add geographic diversification to your investments, if you believe in a global approach to long-term growth, and if you're comfortable accepting some currency and political risk for the potential upside bottom line, the I fund isn't a must-have for everyone. But for long-term investors, it's one more way to build a portfolio that isn't tied entirely to the fate of the US stock market. Now that we've covered the core 5, G, F, C, S, and I, let's talk about the option many federal employees default into, the Lifecycle funds. Don't want to think about allocations? The L funds promise to do the work for you, but are they helping or holding you back? Alright, let's talk about the Lifecycle funds, also known as L funds, because this is where a lot of TSP investors end up by default. The idea is simple. You pick a fund based on your expected retirement year, like L 2040, L 2055, or even L income if you're already retired, and the TSP automatically adjusts your portfolio over time. In the beginning, your L fund starts out more aggressive, heavier in C, S, and I funds to promote growth. Then, as your retirement date approaches, it gradually shifts toward more conservative options like F and G funds to reduce risk. Sounds pretty convenient, right? And it is. If you don't want to worry about rebalancing or learning how each fund works, the L funds give you a set it and forget it strategy that still includes diversification and risk adjustment. But here's the thing, convenience isn't always optimized for performance. L funds are one size fits all. They don't take into account your actual risk tolerance, your other investments outside the TSP, whether you're pursuing FIRE or a traditional retirement, or if you need a more aggressive or more conservative approach than the default setting provides. Also, the L funds tend to be a little more conservative than many people realize. That means if you're early in your career and looking to grow aggressively, the L fund for your target date might be holding you back. So here's the bottom line. L funds are better than doing nothing. They're balanced, automatic, and low maintenance. But if you're willing to take control and learn about the individual funds, you can often build a portfolio that's better aligned with your personal goals. Now let's put it all together. In the final section, I'll walk you through sample allocation strategies based on your age, risk level, and retirement timeline, so you leave this video knowing exactly how to build a smarter TSP. Wondering how to mix the TSP funds without blowing up your retirement? Let me show you the smartest allocations by age and goal. No guesswork needed. Alright, now that you know what each TSP fund does, let's answer the big question. How do you actually put them together into a smart portfolio? I'm going to give you some simple sample allocations based on your age, your retirement goals, and your risk tolerance. These aren't one size fits all, but they'll give you a strong starting point and you can tweak them from there. If you're in your 20s or 30s, go aggressive. You've got time. Your biggest asset is the ability to ride out the market and let compounding do the heavy lifting. Here's a sample allocation. 45% in the C fund, 30% in the S fund, 20% into the I fund, and 5% G or F fund, just a tiny cushion. This is designed for maximum growth over decades. Yes, it will be volatile, but you have time to recover from market dips, and the reward is bigger long-term gains. If you're in your 40s or early 50s, shift to balanced growth. You still need growth, but now you want to dial down the roller coaster a bit. Here's one approach. 35% in the C fund, 20% in the S fund, 15% for the I fund, 20% in the F fund, and 10% G fund, and this balances upside with stability. It's also more aligned with people thinking about FIRE, where early retirement income planning is key. If you're within 5-10 years of retirement, get conservative, but not too conservative. At this stage, your number one job is preserving your gains, but don't cut growth entirely. Retirement can last 30 years. Try this mix. 25% in the C fund, 10% S fund, 10% in the I fund, 30% in the F fund, and 25% G fund. This blend gives you income stability with enough equity exposure to outpace inflation. Already retired or taking distributions? Protect and preserve. Now you're drawing down, and stability matters most. That means heavier G and F fund allocations. So, 10% in the C fund, 5% in the S fund, 5% for the I fund, 35% in the F fund, and 45% G fund. Use the G fund for near-term withdrawals, and the rest to keep pace with inflation over time. Quick notes. Always rebalance once or twice a year to keep your target mix on track. Consider pairing this with Roth versus traditional contribution strategies for tax efficiency. And remember, if this feels overwhelming, start simple. Even just knowing your risk level and matching it to a rough allocation puts you ahead of most investors. You don't need to be a financial advisor to build a smart TSP portfolio. You just need a clear understanding of what the funds do and a plan that matches your timeline and goals. So there you have it, the TSP funds, finally broken down in plain English. If you made it this far, you're already way ahead of most federal employees when it comes to understanding your TSP. And the truth is, these 5 funds are the foundation of your retirement wealth. But knowing about them is just the beginning. How you use them is what actually builds your future. So here's what I want you to do next. First, hit the like button if this helped you. That tells YouTube to push this out to more feds trying to figure out their retirement like you are. Second, subscribe to the channel because I post new videos every single week to help you make smarter decisions with your TSP, your federal benefits, and your side income strategies. Third, and this is a big one, check out my other video where I break down the Roth versus traditional TSP and how your tax bracket could be costing you thousands. It's linked right here on the screen and in the description. And hey, if you're feeling stuck with your allocation or you're not sure how aggressive you should be, drop a comment below with your age or retirement goal. I reply to as many of them as I can, and I'll help you figure out what makes the most sense for your situation. Your TSP shouldn't be confusing. It should be working for you. Thanks for watching. Stay focused, stay informed, and I'll see you in the next one.